Sounds good.
Welcome to another episode of OTA on the Air. My guest with me today is Bob Costello with the American Trucking Association as their chief economist. So welcome to the show, Bob.
Hey, my pleasure to be here.
So obviously top of mind is this wonderful, wonderful world of the economy right now that nobody seems to be able to put their thumb on what's going on. And let's talk a little bit about what you're seeing and what you see has kind of caused us to get to this point.
Yeah. So, I first of all, you're exactly right. I mean, it's always a challenge to forecast the economy, but those challenges have risen significantly here in the last few months, no doubt about it. But here's sort of my top line stuff that I'm thinking about right now. First of all, I think everybody needs to realize the probability of a recession in the next 12 months is rising, but that is not the baseline forecast. Okay, the baseline forecast is to go from well above trend growth to actually below trend growth, but not an actual contraction yet. Now, with that said, as I said, we need to watch this closely because the probability has gone up. We're probably about a 50% chance of a recession over the next 12 months. That is up significantly from, say 3-4 months ago when it was probably 30%. So, but anyways, that's where we are with that. Listen, consumer spending on goods is going to contract this year. No doubt about when you take out inflation or adjust for inflation, but it's still going to be pretty high and higher than we even saw in 2020. So last year was just a killer year for that. So that's happening. The Fed's going to continue to be aggressive in terms of interest rates. And if we're at 1.5% for the Fed funds rate, they just increased it by 0.75 of a point. We're probably going to be closer to a little over 3% by the end of the year. And so that's something to watch for. Now, historically, like in recent terms, that's pretty high, but historically it's not high at all. And so that's sort of the big picture stuff. I'd be more than happy to get into more details on some of that, but that's the big picture stuff I'm looking at.
Yeah, I guess talk a little bit about that Fed rate piece. Obviously they take a look at rates to try to slow the economy down, slow inflation down. I guess, how does that work in, I guess, a very high level way? But I mean, and is, when that news came out that they raised it 0.75 of a point, it was almost like the earth had stopped moving for a while. I guess, what is the real world impact of that? I mean, obviously housing is still going to grow just by sheer demographics and the need for housing. I guess, what sort of impact is that 0.75 of a point going to have on like the housing market and the rest of the economy?
Yeah. So here's what's going on. All right. So if you, so the sources of inflation are a few, but we heard for a long time, and now it's a bit of a joke, but it was this idea of transitory inflation, right? That we were having all these supply chain problems, and therefore we had temporary inflation as supply chains were not able to meet the demand of consumers. Now, I have to tell you, that was the wrong term to use, but the idea was right. But the problem is we still have supply chain problems and they're still not caught up. So I don't think you can know, and at this juncture, you can't call it temporary or transitory because it's been going on for too long, but that is absolutely happening. But the other big source of inflation is the government spent a heck of a lot of money, right? And trying to pump up the economy through the pandemic. And, we could easily argue that a lot of that was good and maybe that last bill was not, right? And that sort of put us over the edge. But what that has done is that has helped in turn, pumped a lot of money in the economy. Labor was hard to find. So what are businesses doing? We know this well in trucking, right? I mean, wages are going up a lot. So let me just give you some numbers around that. If you look from across all occupations and you look at wages and salaries from 2010 to 2020, it averaged 2.3%. Last year, we were up 3.6%. This year, we're going to be up 5.9%. So what's happening is So people have more money in their pocket. And so as this stuff is getting, they're spending it. And that is also one of the things that is driving up inflation. And people are like, okay, this is hard to find, but I really want it. And so I'm willing to spend more for it. And that is what has happened. So you've got these two sources of inflation. That means the CPI, is up, 8.6% year over year. We haven't seen those sort of numbers since the early 1980s. And yes, it'll start to slow down, but even by the end of the year, you're still going to be at, my calculation is as of right now, it's still at like 7%. So that leads us to how is the Fed going to correct this situation, right? So first of all, they cannot correct supply chain problems, right? There's, the only way to do that, and really the way they're going to tackle all this, is to sort of crimp off demand. So how do you do that? You start increasing interest rates, and we're already seeing that then having a ripple effect, as you said earlier, through the housing market. So housing's going to cool down. It's still, I think, going to be decent this year, but it is absolutely going to cool down as some people that were in the housing market are no longer in it because mortgage rates are going up. But it's also gonna hurt demand for big ticket items where you would take out a loan, right? Autos is a prime example of that, and other types of items. So people are like, and what's happened, and so that's really the way the Fed is going to try to attack this, because they have a very blunt tool, right? They cannot be real precise and go in there and go, we're just going to carve out this little inflation. No, it's a blunt tool. It's like a sledgehammer, and they just go in and they're going to increase interest rates to try to, squash some of this demand. And that's really what they're trying to attack. Now, if we look at, give you an outcome of what's going to happen as a result. So if we look at the unemployment rate, because what they're trying to do is also slow down the labor market, right? So that wages stop rising so much. So in order to do that, they need the unemployment rate to go up. So prior to the pandemic, we were at 3.5%. That was a 50-year low. In May of this year, we were at 3.6%. So it went up to almost 15%, and it came all the way back down to 3.6, almost back to that 50-year low that we saw prior to the pandemic. The Fed needs that unemployment rate to get up to about 5%. And when it does that, then they'll start feeling, okay, now businesses are not out there just throwing money at people to get them to come to work. And that will help also slow down inflation.
So what is the impact on that with workforce participation? Have we seen workforce participation come down during the pandemic, and then that is affecting the unemployment rate? I guess, that side of the argument has always been, yes, unemployment is low, but the workforce participation is also dropping.
Well, it is now improving. Yeah, it is improving though now, right? So it has gotten better. And if you look at, you're exactly right. You need to look at those numbers too. And of course we do that and so forth. But if you look at the labor force participation rate of what I would call, premium working ages, right? So like early 20s to about 60 years old, that's actually gotten better as well. So, but is it back to where we were a couple decades ago? No, it's not. And that's one of the interesting things that we have going on in our economy, because some of these other, if you go to like, say, Germany, right? Germany, think about this. Germany has a lot more supports for people that are not working than, say, we do in the US. Yet their labor force participation rate has improved over the years, and ours has gotten worse generally. Again, it's come up from the pandemic, and it's actually even a little bit better than prior to the pandemic in that prime working age. But I think part of that is they don't, a lot of European countries don't put this stigma on blue collar work like we tend to do in the United States. And I think that as a society, we need to really think about that. Why are we pushing all these young people into some of these smaller liberal arts colleges where they come out with not a real great skill set for anything? They're $100,000 in debt and they have no way of paying that off. But if they went off and became a truck driver or an electrician or a plumber, they'd be doing a heck of a lot better because they wouldn't have all that debt. So I do think that that's one of the issues. So to get long-winded answer to your question, there's the long run structural issue that we have with that labor force participation rate, but we have seen some improvement here in recently.
So we obviously couldn't talk about economic impact without talking about fuel prices. Obviously gasoline is up and has an impact to everyday Americans' pocketbook, but the real issue is diesel and the impact that that has on consumer prices. And on that side of you, what are you seeing as far as the impacts of the increased fuel costs? And are you seeing or think you're seeing any relief in sight?
So unfortunately, the short answer is there's not going to be a lot of relief in sight. And let me tell you why that is. It has very little to do with pumping crude oil out of the ground. We're seeing that going up. We're seeing that improve. And if you were to look at year over year growth rates in, say, the price of crude oil versus the price of gasoline and the price of diesel, you would see that while it is up for crude, it is up a lot less. So what does that tell me? That tells me our problem is not pumping crude out of the oil, or I'm sorry, crude out of the ground. Our problem is refining it. And we haven't built a new refinery in this country in decades right now. And then during the pandemic, and that doesn't mean, prior to the pandemic, these refineries were boosting their capacity within each of those, even though we hadn't built new ones. But during the pandemic, they actually reduced capacity levels, and that's not coming back. So that's a big problem. And so you add it all up, and I don't think, and the other thing is, think about this. I mean, this is a huge assumption, but put the red tape aside to build a new refinery. Just move it aside. It's huge. It's immense. That alone would stop you from doing it. But let's assume that doesn't stop you from doing it. I actually think, and because every time even if you maximize middle distillates, right? So diesel fuel and jet fuel and all that, even if you maximize that production, you still get a lot more gasoline with every barrel of crude oil than you do diesel, right? And as a refiner, I don't want to make excuses for them, but longer term, if they look out and they see more and more electrics coming, still a relatively small portion of the overall car market, but growing, why would you want to invest billions in a product that you think the demand is going to slip for you? And so that's also a problem. So long-winded answer to your question is, maybe we'll get some temporary relief coming up and so forth. The long-term fundamentals of the diesel market are not great for all of these reasons.
Well, I guess from that refiner, I mean, without question, refining capacity is really where the bottleneck is in this whole process, and it's like the LA port, right? There's just not enough outflow coming out of there with the amount of inflow that's in there. But if you're a refiner, and yes, you're going to pull more gallons of gasoline from a barrel than you are diesel, but you're seeing down the road and knowing full well that the economics of electric cars and the capacity of electric cars is much greater than what it would be in electric heavy duty vehicles. Is there a mindset switch out there where they then start refining more diesel as an opportunity for growth and less gasoline? Do they make that switch? Is it even economically viable for them to make that switch?
Well, so it's a good question, but the practical answer to that is you can only maximize so much diesel. You cannot take a barrel of oil and say, I'm going to make all diesel, right? You can maximize that diesel. They're already doing that. And by the way, refineries are going there, nothing can run at 100%. They're as close as you can get to running at 100% right now. They're at like 96% of capacity. That actually scares me, because that's when things break down, when you're going that hard. So I'm not predicting that we're going to have a problem here coming up because they're doing that, but it's a potential. But anyway, you can only maximize, and I don't have the exact numbers for you, but even when you maximize distillate production, you still get roughly twice as much gasoline than you do diesel. So you cannot make all distillates. So it's just a practical matter that they're going to be making all this gasoline, even if in the future they don't need it. And that's what scares me longer term about the diesel market.
So I guess talk to us a little bit about, what that impact has down to the consumer price. When we're saying that, you're taking a look at $6+ a gallon for diesel for the trucking industry, which then comes down into whether it's passed on as best it can through fuel surcharge or increased rates. When you have that long-term play, what does that mean long-term for consumer price?
Yeah, well, obviously it's not a good thing for consumer prices, and it's going to push them up. Now, I get this question from the media all the time. It's like, they sort of boil it down to, all right, how much is a gallon of milk going to cost more because of diesel's up for truckers? And what I say is, I can't answer that, right? Because it just depends on, okay, so we know what generally happens with fuel surcharges, but what we don't know is, okay, how much more is everything from the farmer all the way to the grocery store going to absorb versus pass along? And that really is depending on each, cycle and so forth. But I'll tell you this, the one of the problems and one of the reasons why the Fed is nervous about inflation, and while they're being so aggressive, and I'm not discounting at all another 0.75 point hike next month when they meet again, it's because when inflation goes up, it's easier to pass along those prices because they can go to consumers, they can go to their and say, hey, listen, everybody's prices are up. I got to pass this along. Everything is up. And so that is, whereas if prices aren't up, it's much more difficult to do that, and they're eating more of it. So that's part of the problem with higher inflation in general, is because it becomes sort of a compounding effect that, hey, once you start rolling with higher prices, it keeps happening because everybody's like, oh yeah, I'm seeing higher prices. I get it. And so as before, they might fight you more on it. So I don't know exactly, but absolutely it shows up for consumers. And that's one of the reasons why I think when you adjust for inflation, the actual dollar amount spent on buying goods this year, also because we're traveling more and buying more services, falls. Now, still above 2020 levels, but not as high as 2021.
Yeah, I chuckled a little bit when you said we're traveling more, because it's kind of interesting to take a look at airline prices, and airline ticket costs are just skyrocketing, and they are saying it's fuel related, but full well it's an ability because people are traveling, and the ability to recoup some of the stuff that they lost during COVID, driving a lot of that. Let's talk a little bit about the health of the trucking industry long term. We're obviously going through a lot of M&A. Has always been the kind of the norm. When things are good, people want to sell and get out because there's some value there. What are you seeing in the M&A market? And then on the flip side, what are you going to think we'll be seeing when it comes to failures as this thing continues to grow and expenses continue to mount?
Well, certainly, I'm not going to predict what M&A activity is, but you're absolutely right. And one of the interesting recent trends in that space is some of these bigger companies buying medium-sized fleets and then just letting them run the way they were, right? Just you continue. Well, I'll buy it. It'll be a Costello trucking company, but I'm going to let you run. You did a great job. Keep doing a great job. And so that's one of the interesting trends in that space, versus in years past, you would sort of absorb all of them, really for the drivers as well, right? And you didn't really want the equipment and all, but so forth. So, I think, but a lot of those companies are, because more and more folks want to sell in this market, those that are buying are becoming more selective than they were in the past, which is also something we're seeing. I guess at the bottom line here is, though, for capacity in general and what's happening, you have, my baseline forecast, as I said earlier, is not for a recession. But if it does happen, I think you could have one of the shortest cycles we've ever seen. For the trucking industry. And the reason for that is, if you think about what has transpired in our industry has been very unique. And we've never really seen anything like it. For example, you had a lot of independent contractors leave their company they were leased onto, and they went to the spot market when it was booming. And many of them, including not just independent contractors, but smaller fleets, they were like, boy, spot market's great. I'm making a ton of money. I'm going to get newer used equipment. And they paid a ton for it because there wasn't new equipment out there.
Right.
And so you have folks that I think now that spot market rates are falling and are down, as of today, down 25, 30% from the peak. I just don't know, when you look at fuel prices and you look at driver pay going up, and by the way, maybe you could, a new driver coming in, maybe you can lower that a bit, but you can't go out there and tell your existing drivers you're reducing their pay. I mean, that just isn't going to happen. And so tire prices are up, and liability insurance, we know all about that. My point is, I think there's going to be a lot of fleets that are in trouble. And I think that failures are eventually going to start to tick up. And you will see that. And by the way, there's not new equipment out there to buy. So it's not like some of these other fleets are going out there and adding a bunch of new equipment. They're not, because they can't get it. And those supply chains are still very tough for our OEMs. And so you add all that up, and we are likely to see some of these folks go out of business, and it could be the shortest cycle we've seen potentially ever.
Yeah, I mean, and the interesting part will be is what happens to those equipment, what happens to those drivers, do they get gobbled up? Is there enough demand to offset that? Because obviously when you lose companies, the capacity goes down, but is there the demand to offset to even things out? It's going to be an interesting ride to watch, that's for sure. So I guess what are you, when you look at these things, I guess, what are some of your key indicators that our viewers could take a look at and just, throw on their widget on their phone to be able to say, all right, these are the things that I want to take a look at? Because you take a look at like the stock market. I mean, there's just some interesting plays in the stock market right now where you've got, some mainstay businesses that are no chance of, ever failing, down 25, 30% on value in the week. What are some of the key indicators that you take a look at when you're doing this analysis that folks can use as kind of business intelligence?
Yeah. So first of all, people always ask me about the stock market. I'm like, listen, if I was any better than anybody else, I probably would be on a beach somewhere. So, because the hard thing for an economist like me is I'm dealing with what's happening, not expectations, right? And so, you can get a really good quarter, but because in the stock market they were expecting a slightly better, the market goes down, right? So just put that aside for me. I like to, for the trucking industry, I'm going to talk about the buckets of freight, and there's three big ones, right? It's consumers. So there, you need to look at things like retail sales. What are retail sales doing? And what types of retail sales, right? I mean, you can look at essentially online versus brick and mortar. Those are types of things I really look at. Another one is I like to look at the inventory cycle. And I look at data also from the Census Bureau, and it's if you look at the dollar value of inventories right now, they're very high, but it's not inflation adjusted. And when you look at inventories, I think the way you absolutely should look at them is relative to sales. They've ticked up a little bit, but they are not at all-time highs, not even close to it. And in fact, I think while you heard some retailers have a mismatch of merchandise and all, I am of the belief, and I think the data points to overall inventories are not bloated, and that's a good thing for our industry. Another one I'm going to look at, and I look at closely, is what's going on in construction, and specifically, are we building more homes? And even though I think the homes, we'll build fewer homes this year than last year, it's still going to be a pretty high number despite rising mortgage rates. So there's still a lot of pent up demand for housing. We underbuilt for years, and millennials are finally in the housing market. And so, yes, housing overall, existing home sales are going to come down. We're going to build fewer homes. I'm not going to tell you anything but that. All I'm saying is, relative to recent history, it's not going to be completely terrible. And then there's the industrial side of the economy that's important. And I like to look at manufacturing output by the Federal Reserve, and that number's high. And in all this mismatch of products and supply chain woes and so forth, I think this is the bright spot of the U.S. economy right now. So despite all of that, we're building, we're going to see manufacturing output go up about 5% this year after growing 6.5% last year. So that's really strong. So that's really for in terms of freight, one of the strong places. So those are in a nutshell. It's a lot more complicated than that, but those are some of the indicators I like to look at.
All right, so here in Ohio, everyone is waving the flag of victory because we have an Intel facility going in here and whatnot, and the chip shortage being what everyone looks back, especially when it comes to automobiles. How does this thing unravel? How does that, when you've got all these facilities, they're still manufacturing vehicles, they're still producing these items, what is the long-term play when it comes to equipment? We've got a lot of pent up desire to buy. There's no supply of new. So then the used market's going through the roof. I guess, how does this all unravel? Is it this, I think everyone thinks that all of a sudden there's going to be, 1 million chips available. They're just going to plug them and release all this inventory onto the market. How does this thing work? How does that thing unravel when it comes to the equipment shortage and availability, and what does that look like?
I think we're in this cycle for a while, right? Because those whether it's you guys in Ohio or it's Arizona, we've got some plants going up. Those take years to build, right? And so yes, the companies in Taiwan are starting to produce more, but it's not enough. And that's why you hear some of these auto plants are actually going to make their own chips in the near term, at least, to try to supplement it. But bottom line for the trucking industry is the new equipment market is going to remain challenging, both trucks and trailers, for the rest of this year and well into next year. And that's one of the things that's going to keep a lid on capacity growth. But you're going to be fleets are going to be frustrated with the availability of new equipment, and I just don't see that changing.
Well, Bob, as always, it's extremely enlightening to have you give your take on what's going on. I used to always joke many years ago that I could give your speech because it was always the same year over year. But I can tell you the last few years, it's been always very interesting to hear what your take is, because you're never quite sure what's going to happen next, and really what the indices that you look at, what that projects moving out in the future. So thank you for participating, and thank you for being a part of this, and looking forward to hearing you this fall in San Diego at MC&E, and see how this stuff progresses moving forward through the summer.
It's interesting times, Tom, and there's no doubt about it. And so folks need to, keep their ear to the ground, because things can change pretty quickly in this sort of environment. But anyways, thanks for having me, and I look forward to seeing you soon.